You've got $847 in your checking account. Somewhere across town, a hedge fund manager just earned that in the time it took you to read this sentence. Somewhere else, a government just created $100 billion by typing numbers into a computer. And in a glass tower in Lower Manhattan, 23-year-olds in suits are structuring deals that will determine whether entire companies live or die, while charging fees that would make your mortgage look modest. None of them learned this in school, neither did you. And that gap is between the people who understand how money actually works and the people who don't, is one of the most expensive gaps in modern life. My name is Nick, and today we're going to close it. We're going to explain the entire financial system, from the first coin ever minted to the digital currencies governments are quietly building right now, in one video. Every institution, every mechanism, every scandal worth knowing about. Let's go. Before we talk about banks, markets, hedge funds, or any of that, we need to start at the foundation. And the foundation is weirder than you think. Money is not real. I don't mean that in a philosophical stare at the ceiling way. I mean it literally. A $100 bill contains about 12 cents worth of material. It works. It buys things, it pays rent, it settles debts, not because of what it is, but because of what everyone agrees it is. Money is a shared fiction, the most successful shared fiction in human history. To understand why we invented it, you have to understand what came before it. Barter has a fatal flaw called the double coincidence of wants. You need shoes, I need a haircut. Unless those two needs perfectly overlap, we're stuck. A society built on barter grinds to a halt fast. So humans got creative. Commodity money emerged. Objects with inherent value that could also be used as currency. Cowrie shells in ancient China. Salt in Rome. Soldiers were partly paid in salt, which is literally where the word salary comes from. Cattle, tobacco in colonial America. The first standardized coins were minted around 700 BC in Lydia, modern Turkey, from electrum, a naturally occurring gold-silver alloy. And for the first time, you could carry wealth in your pocket without bringing a cow. Then paper happened. China invented it around 1,000 years ago. Merchants traded receipts instead of hauling heavy coins. Marco Polo saw it and wrote about it with amazement. Europeans thought it was insane. They came around. For thousands of years, paper money carried a hard constraint. Governments could only print as much as they had gold to cover. That constraint was both its strength and eventually its end. August 15th, 1971. President Nixon ended the direct convertibility of the US dollar to gold in a Sunday night TV address. Before that, every dollar was technically exchangeable for a fixed amount of gold. After that, on the dollars and every other major currency Ashin was backed by nothing, except the full faith and credit of the issuing government. This is fiat currency, from the Latin for let it be done. The government decrees it has value, and because everyone agrees, it does. Here's the number that should stop you cold. Only about 8% of the world's money exists as physical cash. The other 92%, digital entries on computer servers, numbers in databases. When you check your bank balance, you're not looking at a pile of bills with your name on it. You're looking at a record, a promise, a number that everyone agrees represents something real. And now, in 2026, governments themselves are building digital versions of their currencies, which raises questions about money, privacy, and control that would have seemed like science fiction 20 years ago. But we'll get to that. So, money is a shared social contract. It works because we all believe it works. The moment that belief cracks, economies collapse. Keep that fragility in mind. It comes up again. Now that we understand what money is, we need to talk about who controls how much of it exists. In every major economy, there's a central bank. The United States has the Federal Reserve. The UK has the Bank of England, the Eurozone has the European Central Bank. These institutions don't serve regular customers. They don't have ATMs. They are the banks for banks. The operating system for the entire economy. Their job has three main levers. Lever 1, interest rates. The Fed sets the federal funds rate, the rate at which banks lend money to each other overnight. This one number cascades through the entire economy. When it goes up, your mortgage gets more expensive, your car loan costs more, businesses borrow less, the economy cools. When it goes down, borrowing gets cheap, people spend more, the economy heats up. We saw just how painful this lever can be recently. The Fed hiked rates to a peak of 5.25 to 5.5%, the highest in 23 years, to fight post-COVID inflation. That one decision changed the math for every borrower in America. Lever 2, quantitative easing and tightening. When cutting rates alone isn't enough, central banks have a more powerful tool, buying assets directly. Quantitative easing is when the Fed buys government bonds, injecting money into the financial system. It doesn't print physical bills. It creates digital reserves at banks, essentially typing numbers into a computer. Quantitative tightening is the reverse, selling assets, shrinking the money supply. The scale of this is genuinely staggering. Before the 2008 financial crisis, the Fed's balance sheet was $0.9 trillion. By 2015, post-crisis, it had ballooned to $4.5 trillion. Then COVID hit. By early 2022, the balance sheet reached $8.9 trillion, a nearly tenfold increase. For context, that's more than the entire GDP of Japan. Lever 3, lender of last resort. When banks can't get money anywhere else, they can go to the Fed. This backstop is what prevents a panicking bank from becoming a failing bank. It's the financial equivalent of a 911 call. Like, you hope you never need it, but knowing it exists keeps everyone calmer. The COVID era proved just how powerful and dangerous these tools are. The Fed slashed rates to near zero and launched the biggest QE program in history. Combined with $5 trillion in fiscal stimulus from Congress, this kept the economy from collapsing, but it also meant the US government effectively created roughly 40% of all dollars that had ever existed in less than 2 years. The bill came due in 2022. Inflation hit 8%, the highest since the early 1980s. Now, the Fed responded with the most aggressive rate hiking cycle in decades, and that hiking cycle, as we'll come back to later, broke some banks. The central bank is like a thermostat for the economy. Too hot, it raises rates to cool things down. Too cold, it cuts rates to warm things up. QE is switching on an emergency space heater during a deep freeze. The problem is that if you leave it on too long, the room overheats, and the thermostat has an 8-week delay. They're steering a supertanker through fog with a lag in the steering wheel. There's no perfect move, only trade-offs. Here's something that will mildly ruin your day. When you deposit $1,000 into your bank account, that money doesn't sit in a vault with your name on it. The bank takes most of it and lends it to someone else immediately. The money you deposited this morning is already gone. Someone else is buying a car with it right now. This is called fractional reserve banking, and it's how money multiplies. Banks keep a fraction of deposits as reserves and lend the rest. Under the traditional model, a 10% reserve requirement meant $1,000 in deposits could support $10,000 in total lending, money effectively created from nothing. But here's where it gets truly wild. In March 2020, the Federal Reserve eliminated reserve requirements entirely, dropping them to zero. The St. Louis Fed, presumably with a straight face, published a paper titled RIP, Money Multiplier. U.S. banks are now legally required to hold 0% of your deposits in reserve. Before you spiral, this doesn't mean they can lend infinitely. Capital requirements and their own survival instincts keep them in check. But the traditional textbook model of banking is officially dead. The more accurate picture of modern banking: banks create money when they make loans. When your bank approves a mortgage, it doesn't transfer existing money. It credits your account with new money, money that didn't exist 5 minutes ago. The loan creates the deposit. Money is created from a promise to repay, which means the money supply expands when lending is enthusiastic and contracts when banks tighten credit. Exactly why credit crunches are so economically devastating. How do banks actually profit? They borrow money cheaply, like your savings account, and lend it expensively. Your mortgage, your car loan, your credit card. The difference is called the net interest margin. JP Morgan Chase holds $4.56 trillion in assets, more than the GDP of Germany. The big four US banks combined hold over $15 trillion. They are not intermediaries, they are the economy's circulatory system. The system has one catastrophic vulnerability: bank runs. Because banks lend out far more than they hold, they cannot survive a situation where many depositors demand their money simultaneously. The FDIC, created in 1933 after roughly 9,000 banks failed during the Great Depression, insures deposits up to $250,000 and has prevented any insured depositor from losing money in its 90-year history. That guarantee is the only thing standing between routine panic and full collapse. We saw exactly how fragile this is in March 2023. $42 billion was withdrawn from Silicon Valley Bank in a single day, the largest bank run in history. Not people lining up outside branches with grocery bags, in startup founders tapping their phones in their kitchens. SVB went from a press release saying it was in sound financial condition to federal seizure in 48 hours. The bank run that took weeks to destroy banks in the 1930s now happens in an afternoon, turbocharged by group texts and Twitter. 3 of the 4 largest bank failures in U.S. history happened within 2 months of each other in 2023. The system is more fragile and faster moving than most people understand. So we've covered where money comes from and how banks multiply it. Now we need to talk about the people who move it at a scale that makes your bank look like a lemonade stand. Commercial banks serve regular people and businesses. Investment banks serve corporations, governments, and institutions, and they sit at the center of everything that makes capitalism either brilliant or infuriating, depending on your mood. Investment banks do 3 things at extraordinary scale. First, IPOs. When a private company wants to go public, it hires an investment bank to manage the process. The bank values the company, sets the share price, prepares mountains of legal documentation, and convinces institutional investors to buy. Like on May 18, 2012, Morgan Stanley led Facebook's IPO, raising $16 billion in a single day, the largest tech IPO in history at the time, valued at $104 billion. Days before, Facebook told the underwriting banks to lower revenue estimates because mobile advertising was underperforming. The banks informed their institutional clients. Regular investors were not informed. The stock crashed 53% within 4 months. 40 lawsuits followed. Morgan Stanley paid hundreds of millions in settlements. The punchline: Meta now generates over $50 billion in quarterly revenue, more than its entire market cap at its September 2012 low. Being right long-term doesn't mean the process was clean. Second, mergers and acquisitions. When one company wants to buy another, investment banks advise both sides, run valuations, negotiate terms, and ensure the deal closes. This requires armies of analysts working through the night, trying to figure out whether the target company is a diamond in the rough or a dumpster fire wearing a nice suit. Third, raising capital. Companies constantly need money. New bonds, secondary stock offerings, leveraged loans. Investment banks are the plumbers who make that happen, and they charge generously for the service. Think of them as high-powered real estate agents for the corporate world, except instead of 6% on a $500,000 house, they're taking fees on deals worth billions. Now, the most impressive crime in modern financial history, Malaysia's sovereign wealth fund, 1MDB, needed to raise money. The Goldman Sachs arranged $6.5 billion in bond offerings and charged fees so unusually high that executives internally flagged them as a potential regulatory concern. Reality: $4.5 billion was stolen. The money funded a $250 million yacht, luxury real estate across 3 continents, Picasso paintings, and, in a detail that would be funny if it weren't enraging, a stake in The Wolf of Wall Street, a film literally about financial fraud. Goldman paid $2.9 billion in regulatory fines worldwide, and plus a $3.9 billion settlement with Malaysia. Internally, one of the 1MDB deals had won one of Goldman's most prestigious awards for creativity and entrepreneurial thinking. The financial system rewards results. It asks questions much later. A stock is simple: a fractional ownership stake in a company. When Apple issues shares, it's selling pieces of itself to raise money without borrowing. When you buy a share, you own a tiny fraction of Apple's cash, products, future earnings, and voting rights. The New York Stock Exchange started in a wonderfully unglamorous way. On May 17, 1792, 24 brokers signed the Buttonwood Agreement under a sycamore tree at 68 Wall Street, pledging to trade securities only with each other at a fixed commission. That's it. A contract signed outside under a tree by 24 guys who wanted to corner the market. Today, the NYSE has a market cap of roughly $30 trillion. NASDAQ, launched in 1971, became the home of technology companies, Apple. Like Microsoft, Amazon, Nvidia, together, the US stock market represents nearly $62 trillion in market cap. The S&P 500, tracking 500 large companies weighted by market cap, is the benchmark everyone means when they say the market. The Dow Jones tracks just 30 companies and is price weighted rather than cap weighted, making it a somewhat outdated measure, but it's 130 years old and nobody wants to let it go. The long-run case for stocks is compelling. Like the S&P 500 has returned an average of 10.4% annually since 1928, or about 7.3% after inflation. Consider Sarah. She put $200 a month into an S&P 500 index fund at 22 and never looked at it again. No stock picking, no timing the market, just automatic contributions every month. At 65, her account holds just over $1.1 million. She didn't beat the market. She didn't need to. She just let time do what time does. But two things make stocks psychologically brutal to hold. A volatility like the S&P 500 dropped 34% in 33 days in early 2020, the fastest such collapse in history. And inequality, roughly 62% of Americans own stock, but the wealthiest 1% hold 50% of all shares. When the market crashes, nearly everyone feels it indirectly through pensions and retirement accounts. When it booms, not everyone benefits equally. Well, here's the single most important practical lesson from 150 years of market history. Missing just the 10 best trading days in a decade can cut your total returns in half. Those best days almost always happen right in the middle of bear markets when panic is highest. The investors who stay and win, the ones who try to time their way out and back in, almost never get it right. The market rewards patience in ways nothing else does. In 2022, the bond market did the unthinkable. It crashed in tandem with stocks. The asset that is supposed to be the safest thing on earth lost value at a speed that stunned Wall Street. Investors who thought they were protected lost nearly 20% in long-term treasuries. That's the bond market. It's bigger than the stock market, more powerful than most governments, and almost nobody under 40 pays attention to it. The global bond market stands at approximately $142 trillion, larger than global equities at $115 trillion. Central banks, pension funds, insurance companies, sovereign wealth funds, the biggest pools of money on earth invest primarily in bonds. Their mood controls what happens in stocks, housing, and every other asset class. A bond is an IOU. When the U.S. government needs money, it borrows by selling treasury bonds. You give the government $1,000. They pay you regular interest for a set period. Then they return your $1,000. Your mortgage interest rate was ultimately set by this market. Though when bond traders in London decided the economy was slowing down, your borrowing costs went up. Not because you did anything wrong, but because of a number on a screen 5,000 miles away. The single most important relationship in fixed income, bond prices and yields move in opposite directions. Owning a long-term bond when interest rates rise is like signing a 30-year lease at today's rent, then watching identical apartments rent for half the price next year. You're locked in. But the market has moved on. Your bond is worth less because new buyers can get a better deal elsewhere. It also explains why 2022 was the worst year for bonds in 270 years. When the Fed hiked rates from near zero to over 4%, 30-year Treasury bonds, supposedly one of the safest assets in the world, lost nearly 39% of their value. People who thought bonds were safe got a rude awakening. The most predictive signal in all of macroeconomics also sits in the bond market. The yield curve. Plot bond yields from shortest maturity to longest, and normally it slopes upward, more reward for longer commitments. When it inverts, short-term rates exceeding long-term, markets are signaling they expect the economy to weaken. An inverted yield curve has preceded 7 of the last 8 U.S. recessions. The inversion that began in 2022 became the longest in 45 years. James Carville, Bill Clinton's political strategist, once said he'd want to come back as the bond market because it can intimidate everybody. Like, he wasn't joking. When bond markets speak, governments listen, whether they want to or not. If bonds are the boring market that runs everything, what we're about to cover is the market that everyone's heard of, but almost nobody actually understands, and the people who figured out how to rig it. Now we get to the part of the financial system with the best stories. The hedge funds are private investment vehicles for the ultra wealthy. Not for you, not for most people. To invest, you need either $1 million in net worth or $200,000 plus annual income. In practice, minimums start at $250,000. The industry manages roughly $5 to $6 trillion. Hedge funds can do things regular accounts legally cannot. Bet that a stock will go down by short selling. Use borrowed money to amplify bets by 3 times, 5 times, 10 times. Trade options, futures, swaps, and exotic derivatives. Invest in currencies, commodities, private credit, crypto, and the outcome of elections. Fewer regulations, more firepower. Higher risk. The fee structure is called 2 and 20. A 2% annual management fee on all assets, plus 20% of all profits. This sounds reasonable until you do the math. A billion-dollar hedge fund charges $20 million per year before making a single trade. LCH Investments calculated that since 1969, hedge fund investors have paid nearly half their total profits as fees. It's the greatest legal wealth transfer in modern finance, and the clients keep signing up. Most hedge funds don't beat a simple index fund. Warren Buffett proved this with a $1 million bet in 2007. One S&P 500 index fund versus 5 funds of hedge funds over 10 years. The result? The index fund returned 7.1% annually. The hedge funds returned 2.2%. Not even close. These are people with Ivy League degrees, Bloomberg terminals, and expense accounts. And nearly all of them, over time, lose to a fund that requires zero thinking, zero skill, and charges less per year than a Netflix subscription. Then there's the exception that makes all the rules irrelevant. Jim Simons's Medallion Fund. Simons was a mathematician who built an algorithmic trading machine that achieved average annual returns of 66% before fees for 30 consecutive years. $100 invested in 1988 became roughly $400 million by 2018 compared to $1,815 in the S&P 500. The fund never had a losing year, well, including 2008 when it returned plus 74.6% while everything else burned down. The secret? The fund was right on only 50.75% of its trades. Barely better than a coin flip, but it executed millions of tiny trades where even that microscopic edge compounded into billions. Renaissance charges 5% management fees and 44% of profits, and it's closed to outside investors. Simons kept the best machine for himself. Now, the stories that prove hedge funds' arrogance has limits. The Big Short. Look, a small number of managers, Michael Burry, John Paulson, Steve Eisman, identified that the U.S. housing market was built on rotten foundations in 2005 and bet accordingly. The Wall Street consensus was that they were crazy. In 2008, they were vindicated. John Paulson earned approximately $4 billion personally, the single largest personal trade profit in history at the time. Burry earned investors $725 million while being pressured to abandon the trade for over a year by his own investors, GameStop. Now, in January 2021, Reddit users on r/Wall Street Bets noticed that GameStop stock had been shorted to an extraordinary degree. More than 139% of its float had been sold short. They organized a coordinated buying campaign. The stock went from $6 to $347. Melvin Capital lost $6.8 billion in January alone, needed a $2.75 billion emergency bailout, and permanently closed in May 2022. An army of retail traders in their bedrooms had destroyed a professional hedge fund, and the financial media spent weeks explaining why this couldn't be happening while it was already over. Two industries that couldn't be more different, except they both charge steep fees and move enormous amounts of money. Private equity buys companies that already exist. The playbook: raise billions from pension funds and institutional investors, add borrowed money, typically 60 to 80% of the purchase price, acquire a company, improve it, or extract value from it, and sell it a few years later at a profit. The debt is placed on the acquired company's books, not the PE firms. The company pays off the loan the PE firm used to buy it. Read that again. The Toys R Us story is the cautionary tale. In 2005, Bain Capital, KKR, and Vornado acquired the toy retailer for $6.6 billion, putting in $1.3 billion of equity and loading $5 billion in debt onto the company. Toys R Us was then forced to pay $400 to $500 million per year just in interest. You think about what that means practically. The person who'd worked the cash register for 20 years, counting down to retirement, stocking shelves on Christmas Eve, gone. No severance, because a firm in New York needed to hit its return targets. Here's the part that gets forgotten. Without the debt payments, Toys R Us was profitable. It still handled 1 in 5 toy sales in the US when it went bankrupt in 2017 and liquidated in 2018. 33,000 workers lost their jobs with zero severance. The private equity firms collected $464 million in fees during ownership. Roughly 40% of retail bankruptcies between 2015 and 2017 were PE-owned companies. Private equity isn't always extractive. Some firms genuinely improve operations and create value, but the structure creates incentives that prioritize short-term returns over long-term health. The math of debt servicing is unforgiving, and the workers are usually the first variable to be optimized. Private venture capital is the opposite in almost every way. VC funds early-stage startups with pure equity, no debt, minority stakes, and it accepts that most investments will fail. The power law governs everything. Out of 100 investments, maybe 60 fail completely, 20 return the capital, 15 return 2 to 5 times. But 5 return 100 times or more, and those 5 pay for everything. The greatest VC bets of the modern era read like fiction. Peter Thiel invested $500,000 in Facebook in 2004 for 10.2%. At the 2012 IPO, that stake was worth over $1 billion, a 2,000 times return. Sequoia put $585,000 into Airbnb in 2009 when it had 2,500 listings and was surviving on novelty cereal boxes. At IPO, Sequoia's stake was worth an estimated $8 to $12 billion. Benchmark Capital invested $9 million in Uber in 2011 and eventually returned approximately $7.7 billion, 750 times. These aren't lottery tickets. They're the results of pattern recognition and conviction executed at scale. Here's the most infuriating stat in all of investing. The average person doing nothing, buying everything, beats nearly every professional fund manager over any 20-year period. Not sometimes, almost always. Mutual funds pool money from thousands of investors to buy diversified portfolios of stocks, bonds, or other assets. Professional managers select the investments. ETFs do essentially the same thing, but trade throughout the day on exchanges. The first ETF was the SPDRS and P500, launched in 1993, and is now one of the most traded securities in the world. Over the 20-year period from 2005 to 2024, 94% of all domestic actively managed funds underperformed their benchmark. On a risk-adjusted basis, 97.3% underperformed. Among top quartile performing funds in 2020, not one remained in the top quartile 4 years later. These are people with Ivy League degrees, Bloomberg terminals, and expense accounts. And nearly all of them, over time, and lose to a fund that requires zero thinking, zero skill, and charges less per year than a Netflix subscription. Picking an active fund manager is like hiring a chef to cook a meal that a slow cooker could make better, more reliably for a fraction of the cost, and then paying the chef 30% of the meal as a tip, regardless of how it tastes. The industry's disclaimer says past performance doesn't predict future results. The industry's business model ignores it. The man who gave ordinary investors an alternative was John Jack Bogle, founder of Vanguard. In 1976, Bogle launched the first index mutual fund for individual investors, a fund that simply bought all 500 stocks in the S&P 500 in proportion to their size. No stock picking, no strategy, just the market. It raised $11 million at launch. Wall Street mocked it publicly as Bogle's folly and called it un-American. Paul Samuelson, a Nobel laureate, I later ranked Bogle's invention alongside the wheel, the alphabet, and Gutenberg printing. Why does it work? Fees. A typical active fund charges 0.5 to 1.5% per year. Vanguard index funds charge 0.03%. On $100,000 earning 7% annually over 30 years, the gap between those fee levels is approximately $165,000, nearly a quarter of your potential wealth, silently extracted in charges you barely notice paying. Yet Warren Buffett's instructions for his own estate put 90% of his wife's inheritance in a low-cost S&P 500 index fund. The man worth $100+ billion recommends the same fund available to anyone with $100. In 2023, for the first time in history, passive funds overtook active funds in total U.S. assets. The revolution Bogle started 50 years ago had quietly, thoroughly won. Quick quiz: what's the world's most powerful investment vehicle? Hedge funds? Private equity? No. And the answer is something you pay every month and hope you never use. Like insurance companies are secretly among the biggest investors on earth. The model: collect premiums up front, pool risk across millions of policyholders, invest the money, and pay claims when they come due, sometimes decades later. The money sitting between premium collection and claim payment is called the float. And it's the most powerful financial concept almost nobody outside the industry understands. Global insurers collected approximately $8 trillion in premiums in 2024 and hold roughly $36 to $40 trillion in total assets, more than the entire hedge fund industry several times over. Buffett's genius was recognizing that insurance companies are accidentally running one of the greatest investment operations in history, entirely legally, and the customers sign up willingly. Warren Buffett acquired a small insurance company in 1967. Over 58 years, he grew Berkshire Hathaway's insurance float from $16 million to $176 billion, an 11,000-fold increase. Unlike a bank that borrows at market rates, Berkshire's float costs essentially nothing. Disciplined underwriting means Berkshire actually earns a profit on insurance operations themselves. They're paid to hold the float. That free $176 billion invested with Buffett's skill produced returns impossible to explain any other way. Berkshire's market cap now exceeds $1 trillion. And the float is a rocket fuel. And the only reason most people have never heard of it is that it's buried inside an industry whose primary product is reading fine print. Everything we've covered so far, banks, markets, hedge funds, insurance, operates mostly in the open. What we're about to get into is the part of the financial system that doesn't. Right now, somewhere in America, a 58-year-old teacher is doing math in her head. the same math she's been doing for a decade, trying to figure out if the pension she was promised actually exists in full. In many cases, the honest answer is not quite. Global pension assets hover around $60 trillion, one of the largest pools of long-term capital on Earth. Norway's sovereign pension fund, the world's largest at $1.77 trillion, owns roughly 1.5% of every listed company in the world. When it shifts allocation, hundreds of billions move. A pension fund is a promise written in pencil. It says, "Work for us for 30 years and we'll take care of you." The problem is that the person who wrote that promise retired 15 years ago, and the person honoring it today is doing math that doesn't quite add up. For most of history, the dominant model was the defined benefit plan. Work 30 years, retire with a guaranteed percentage of your salary. The employer bears all investment risk. Starting in the 1980s, companies migrated to defined contribution plans, 401(k)s, where the employee contributes and bears all the risk. The pension promise became a personal finance problem. The consequences are visible. The median American has about $87,000 in retirement savings. The average American thinks they need $1.26 million to retire comfortably, a gap of over $1 million. 1 in 4 Americans has zero retirement savings. If you work in the public sector, teacher, firefighter, police, there's a reasonable chance the pension you've been promised is underfunded by amounts your employer has no current plan to fix. Public pension funds carry an estimated $1.4 trillion in officially reported unfunded liabilities, with true figures potentially 5 times higher using conservative assumptions. The drama of October 2022 in the United Kingdom shows what can go wrong at speed. British pension funds had adopted leverage strategies involving government bonds. Like when Prime Minister Liz Truss announced unfunded tax cuts in a single statement, bond yields spiked over 100 basis points in 4 days. Margin calls cascaded. An estimated 90% of UK pension funds were within hours of insolvency before the Bank of England intervened. A political speech, not a war, not a pandemic, a budget announcement, nearly destroyed the retirement savings of the world's 6th largest economy in days. Here's a number that should stop you cold. A total assets held by traditional commercial banks worldwide, approximately $183 trillion. Total assets held by the shadow banking system, financial entities that operate like banks but aren't regulated like banks, $256.8 trillion. The shadow system is bigger than the regulated one, and most people have never heard of it. Shadow banking includes money market funds, hedge funds, structured investment vehicles, mortgage REITs, and private credit funds, entities that borrow short-term, lend long-term, and create credit just like banks, but without deposit insurance, without a central bank backstop, and without the capital requirements that constrain traditional banks. It's the same function with fewer safeguards. Think of it like a parallel city built next to the regulated banking city. Both have roads, buildings, businesses doing similar things, but the shadow city has no building codes and no fire department. In good times, it runs smoothly. When a fire breaks out, there's no one to put it out. No, sorry to you, and the flames jump to the regulated city next door. That's 2008, and the shadow city has only gotten bigger since. After the crisis, the shadow banking system didn't shrink. It exploded. By the mid-2000s, it held nearly half of all global financial assets. The shadow grew faster than the substance. One corner of this world nearly destroyed everything in 2008 over a gap of 3 cents. Money market funds promised investors a stable $1 share value. On September 16, 2008, the Reserve Primary Fund announced its value had fallen to 97 cents, 3 cents below a dollar, after $785 million in Lehman Brothers debt became worthless. That announcement triggered an immediate run. Within days, $300+ billion was pulled from prime money market funds. Short-term credit markets froze. Companies couldn't borrow for payroll. The Treasury stepped in to guarantee $2.7 trillion in money market assets. 3 cents. The financial equivalent of finding a penny on the sidewalk almost ended global credit markets. Another piece of plumbing almost nobody knows about: repo markets, where institutions sell securities with an agreement to buy them back the next day, essentially borrowing short term against collateral. Daily volume exceeds $1 trillion. In September 2019, overnight repo rates spiked from 2% to 10% in a single day because routine fiscal timing drained $120 billion from the system simultaneously. The Fed had to inject $75 billion in emergency liquidity. The most liquid market in the world had a stress episode because of tax season. These aren't exotic edge cases, they are structural vulnerabilities baked into the design of the system, and they matter enormously for what happens next. Everything we've covered leads here. The 2008 financial crisis destroyed $11 trillion in US household wealth, cost 8.7 million jobs, and led to 6 million foreclosures. Despite how often it's discussed, most people still have only a vague sense of what actually caused it. Let's go through it precisely. Step 1. Cheap money created an insatiable appetite for yield. After the dot-com bust, the Fed slashed rates from 6.5% to 1%. Safe assets suddenly yielded almost nothing. Every pension fund, insurance company, and bank in the world went looking for higher returns. Step 2. The housing market looked like the answer. Banks began lending aggressively to borrowers with poor credit, yet with zero down payments, with no verification of income or assets. Liar loans. The originating banks didn't plan to hold these mortgages. They planned to sell them immediately and make them someone else's problem. Step 3. Securitization packaged the risk and spread it globally. Banks bundled thousands of mortgages into mortgage-backed securities and sold them worldwide. Private label MBS issuance went from $148 billion in 1999 to $1.2 trillion in 2006. The risk traveled from American neighborhoods to European banks, pension funds, and money market funds around the world. Step 4. CDOs turned risky assets into safe ones on paper. Banks took the lowest rated slices of MBS and repackaged them into collateralized debt obligations. Through financial structuring, roughly 80% of these repackaged slices received AAA ratings, the same rating as U.S. Treasury bonds. This was made possible by flawed mathematical models and by the fundamental conflict of interest that rating agencies were paid by the banks issuing the securities. Moody's profits tripled between 2002 and 2006. Step 5. AIG insured everything and backed it with nothing. Credit default swaps let buyers purchase protection against a bond defaulting, like insurance, but without the reserves. AIG's financial products unit sold $411 billion in credit derivatives, including $55 billion on CDOs stuffed with subprime mortgages. They collected the premiums. They set aside nothing. The CDS market exploded from $6 trillion in 2004 to $57 trillion by mid-2008. 4 times the size of the U.S. economy here, with virtually no regulatory oversight. Step 6. The chain snapped. Home prices peaked in 2006 and began falling. Subprime borrowers defaulted. MBS values dropped. CDOs collapsed. AIG faced catastrophic losses. Bear Stearns sold to JP Morgan for $2 per share. It had been $170 the year before. Fannie and Freddie were nationalized September 7th. On September 15th, Lehman Brothers filed the largest bankruptcy in U.S. history. $639 billion in assets gone overnight. One day later, AIG required an $85 billion emergency loan the day after Treasury Secretary Hank Paulson had publicly promised no more bailouts. Here is the part that should still make you angry. Now, the people who designed these instruments, who knew the models were flawed, who sold securities they privately called crap in internal emails, were, with very few exceptions, fine. They kept their bonuses, many kept their jobs, some started new funds, only 47 bankers worldwide went to jail, over half were Icelandic. The people who lost their homes didn't design anything, they didn't rate the CDOs, didn't sell the credit default swaps, and they just trusted that the biggest financial institutions in the world, backed by the most prestigious rating agencies in the world, weren't lying. 6 million American families lost their homes, not because they were reckless, because the people packaging and insuring the mortgages they signed needed the machine to keep running for one more quarter. We've just covered how the system broke. Now let's talk about where it's going and why the next evolution of money might be the most consequential change in how economies work since Nixon ended the gold standard. We started with cowrie shells. We need to end with what's coming next. Central bank digital currencies, CBDCs, are the digital equivalent of physical cash, issued directly by a central bank. Not crypto, not a bank deposit, not PayPal. The actual currency in digital form in a wallet the central bank controls. Like 134 countries representing 98% of global GDP are currently exploring CBDCs. 11 have already launched. This is not a fringe experiment. This is the next evolution of money. A CBDC is like upgrading from physical mail to email, but where the post office can read every letter, control when you can send messages, and make your letters expire if you don't use them in time. Convenience comes at the cost of control. The largest real-world test is China's digital yuan. Rolled out across 25-plus cities, cumulative transactions have exploded into the trillions. In one Shenzhen pilot, stimulus vouchers were given expiration dates. 90% were spent. You cannot save expiring money. Governments can design money that expires if you don't spend it. Flows only to designated categories or triggers automatically on conditions. This is either brilliantly efficient policy or a surveillance mechanism of extraordinary reach depending on your perspective, and possibly both. In the United States, the resistance to a CBDC is fierce, and it has become a major political battleground, with several states passing legislation to ban or restrict them. The concern is privacy. A government-issued digital currency gives authorities an unparalleled window into every transaction you make. Meanwhile, Russia is developing its digital ruble specifically to bypass Western sanctions. A consortium of central banks, China, UAE, Thailand, Hong Kong, and Saudi Arabia, called Project M-Bridge, is building cross-border payment infrastructure that would route around the US dollar-dominated SWIFT system entirely. The financial Cold War is being fought in code. CBDCs also create a structural threat to commercial banking. If citizens can hold digital currency directly at the central bank, bypassing commercial banks entirely, banks lose the deposit base they need to make loans. The entire banking model, as we've described it, depends on people keeping money at banks. That assumption is about to be tested. Let's zoom out. Everything we've covered isn't a series of separate systems. It's one system, deeply interconnected, where money flows in a continuous loop. Households deposit money in commercial banks. Banks lend to businesses and homeowners. Businesses issue stocks and bonds. Stocks and bonds flow into mutual funds, ETFs, pension funds, and insurance portfolios. Like those institutions allocate to private equity and venture capital, PE buys mature companies, VC funds startups that eventually IPO back into the stock market. Central banks sit at the center, setting interest rates that influence every link. Shadow banking runs a parallel version of most of these flows with fewer guardrails. The scale is almost incomprehensible. Global equity markets, $115 trillion. Global bond markets, $142 trillion. Shadow banking, $256 trillion. And underneath all of that, it's the derivatives market. $699 trillion in notional outstanding. 8 times the value of everything the entire world produces in a year in contracts between financial institutions, all interconnected, all referencing each other. The financial system is like a giant game of Jenga. Each block is an institution, a market, a financial product. You can remove small blocks, minor bank failures, routine losses, and the tower stays up. But pull the wrong one. A Lehman Brothers, an AIG, a leveraged pension fund, right? And the whole tower wobbles. The scariest part, unlike real Jenga, nobody can see all the blocks. Nobody knows which one will bring it down. That's what regulators call opacity. And it's the system's most dangerous feature. What 2008, the 2022 UK pension crisis, and the 2023 US banking stress all share is a pattern. Hidden leverage plus interconnection plus a trigger equals cascade. The trigger can be almost anything, like at a political announcement, a press release, on like a 3-cent drop in a money market fund. Leverage amplifies everything. Interconnection means one failure cascades to others, and the system, by design, creates incentives to add more leverage and more complexity right up until the moment it breaks. After 2008, regulators built Dodd-Frank. They required derivatives to go through clearinghouses, concentrating risk in those clearinghouses. They pushed activity into shadow banking, which tripled since 2009. They required stress tests. Well, yet regulators still missed SVB's interest rate vulnerability in 2023. The system always finds ways around the rules, not through malice, but through the rational pursuit of returns. Each round of innovation creates efficiencies and new fragilities that nobody fully understands until they break. Here's what the full picture tells us about your life specifically. The interest rate on your mortgage was set in a chain running from your bank to its cost of capital to the bond markets to the Federal Reserve. Your retirement account's performance depends on pension fund allocations influenced by private equity returns and equity market indices. The price of your house is connected to securitization markets, to investor demand for mortgage-backed securities, to the Fed's rate decisions. Yeah, the economy you work in is shaped by whether the yield curve is normal or inverted, whether the shadow banking system is running smoothly or freezing up. You are already inside the system. Every dollar you earn, spend, save, or borrow passes through it. Here's the thing, nobody tells you the financial system isn't neutral. It wasn't designed with your interests at the center. It was designed by people who profit from complexity, from opacity, from the gap between what they understand and what you don't. Every unnecessary fee, every predatory loan, every bailout that protected institutions while ordinary people lost their homes, that's not a bug. That's the system working exactly as designed for the people who designed it. Understanding it doesn't make you cynical, it makes you harder to take advantage of. You know why the index fund beats the hedge fund. You know why the bank approved a loan that shouldn't exist. Like, you know what an inverted yield curve means for your mortgage rate. You know how 3 cents nearly ended global credit markets, and in a system this large, this powerful, and this deliberately confusing, that knowledge is not a small thing. That's the financial system. All of it, in one video. If this helped, subscribe. And if you made it this far, you genuinely know more about how money works than most people with finance degrees.